Welcome to Pathway to Property, your go-to podcast for building a property portfolio and breaking down property markets.
Hello, everyone, and welcome to the Pathway to Property podcast. I'm one of your co-hosts, Lachlan, Vidler, and as always, I'm joined by Clifford. Lukey, what's going on, mate?
Not a lot, man. Not a lot. It's June now. The year's getting away from us. It's middle of the year.
It surely is,
mate. Like before we know it, Christmas is going to be on our doorstep, and yeah, it's just flying by.
Mate,
How have you been?
Oh, mate, I'm good. I kind of echo what you're saying. It's strange to think that we're almost in the midpoint of the year, and I was overseas for Christmas. The Christmas that I was going to say that we just had, but really we didn't just have it. But that Christmas, and it literally feels like it was yesterday that I was there, and then suddenly we're now in the middle of the year. Like, it's just crazy how quickly it's going.
I know. And I think when you're busy, man, like just time just gets away from you, and like you just don't. You just don't have the time to really absorb it and take it all in the moment sometimes as well. So
absolutely, I feel like we've been so busy as well. We've had, we've been buying so many properties. We've had a lot of clients coming on board. We've both been, in the gym, being active on our personal sides as well. It's just flown, hey.
Yeah. Well, mate, now my Achilles tendon is all healed up, I can properly get back into it. I haven't been going for the runs that I've been wanting to go on, but I think, in the next couple of weeks, I should be able to stride back into it.
It's the old man Achilles strikes again, isn't it? Well, mate, we got an awesome episode ahead. We're going to be talking all about portfolio reviews and adjustments, and not just talking about it. We're going to be really breaking down why you need to conduct reviews, when you need to conduct them, how to go about it, because a lot of people don't really understand how to do it, why to do it, or when to do it.
Yeah.
And when we do it for the people that we work with, our clients, it's crazy how much money they can save just by being able to review their portfolios correctly.
Absolutely.
Let alone the opportunity cost of when we're able to write them if they've been on the wrong side of their journey.
Yeah.
Maybe we've just got them, or maybe they've been accelerating way fast and they're going to hit their goals way faster than they expect they're going to. But none of that can really happen without doing proper, deep, rigorous portfolio reviews.
Yeah, I couldn't agree more. And I think this ties really nicely to our last episode, which was all about scaling the portfolio. And I think just want to mention that, throughout that process of scaling, you want to be doing this throughout, right?
Yeah.
You want to be reviewing and adjusting throughout. It's not like you get to 3 or 4 properties and then you review.
Yeah.
You need to be doing it every stage of the process, every acquisition that you make.
Yeah.
So,
mate, I couldn't agree more. And I think I just want to have a massive shout out. That was our biggest episode to date. I'm not really surprised that we got the response that we did, but the feedback that we got was around how people loved hearing us sort of actually analytically break down the scaling process of a portfolio, how different, borrowing scenarios are going to impact different ways to scale.
Yeah.
So, big shout out to everyone who tuned in. Biggest response we've had, biggest numbers we've had as well. And then also, we threw out our end of financial year offer at the end of that podcast. So I'm just going to remind everybody about that again before we even dive into this one.
Yeah.
Don't forget to come and have a chat with us. We are running our end of financial year offer. You might be getting $1,500 off your buyer's agency service with us if you sign up. T's and C's do apply, but come and have a chat with us and make sure you mention this offer.
yeah, what's interesting?
Yeah, tell me.
Our last episode, one of our clients that we bought a property for probably about like 4 to 5 months ago, he came back through, he gave me a call, and he's like, Luke, I'm at the gym, I'm listening to the podcast, and then like we're just having a good old yarn, and then 5 minutes later he called me back and he's like, oh, at the end of the podcast, I heard that there was an end of financial year deal going on. I'm keen to get my next property. So we've already started the conversations with him in terms of planning and getting things ready for that next acquisition. But yeah, it just goes to show, mate.
Is he the one that you told me about that had the pretty unreal result?
Yes.
What were the numbers again?
So 4 months ago, I think we picked up the property for him for like $537.
Yeah.
And then got it bank valed 4 months later. Came back at like $640.
$640.
Yeah.
So he's up $100,000 in like 4 months.
Yeah. So it was funny because the reason why we got bank vals done on it was because like he was just sending me an email just saying like, look, like I've been thinking about, doing a few other things and maybe, looking to liquidate my owner occupier so I could go, all guns blazing on the investment side. And he's just like, oh, can we kind of revisit the planning side again? And I was like, yeah, not a problem. Let's just kind of get some vals done on your property just to see where it's at. I know it's only been 4 to 6 months. I didn't really expect it to be growing at that rate. Like I know we pushed good numbers, but then when it came back, I remember when the team told me, my jaw dropped. And I got on call with the client and man, he was over the moon.
Yeah,
so,
mate, that's unreal. Well, there you go. Shout out to our client whose name begins with S. So if he's listening, he knows exactly who he is. But unreal. Yeah. So if you guys want to take advantage of that offer, you want to be trying to make yourself $100,000 in 4 months. You guys know where to do it, and you can even save more money as you do it. So. Let's dive in today, mate. Let's dive in. So we're talking all about the reviewing and then making adjustments to your portfolio. But I think a really good place to start is actually linking it in. You kind of very briefly touched on it with our previous episode around how to scale a portfolio. But I'd just like to throw my 2 cents just for a couple of minutes, maybe.
I'll allow it.
You'll allow it? I appreciate your allowing of it. Look, for me, they're so intrinsically linked, right? Like the whole notion of scaling is that it's getting bigger and it's also getting better, right? Yeah. But like a lot of things, you can't do that unless you go and review what it is that you've been doing, right? And I think it's like if you go and look at anyone who's been successful at anything, they constantly review their performance because you may think you're doing really well, but you could be doing better.
Yeah.
Or you might have made a really good effort and you're not that far off track, but you do need to make 1 or 2 little adjustments. And as we talk about the process of actually conducting a review on your properties and your portfolio and the deep analytical analysis you need to do over the course of this episode, I think people are really going to pick up the fact that like review isn't, it's not simple, but it's also not hard. And like there are different ways to review. And there are different things to review.
Yeah.
And like, yes, you should be doing all of them. But even if you don't do all of them, because maybe you don't have the knowledge or maybe you don't have the time or maybe just flat out lazy, I don't know. But even just doing 1 or 2 pieces of the puzzle could still have phenomenal results for you, right? So for me, the scale conversation and the review and adjustment conversation, they're intrinsically linked.
Couldn't agree more. And I think before we kind of dive deep into this, I was having a little bit of think before we jumped into the studio. And our very first episode that we did was on establishing goals for yourselves.
Yeah, it was.
And then building out that portfolio plan, right? And I think, reviewing and adjusting your plan really ties into that really nicely as well, because as the years goes on, right? As the years go on, like your goals, your plans, things change, right? So if you're reviewing your plan in 12 months' time from now, your goals could be different to what they were previously, right? So things need to be adjusted to
It's funny you bring that up. I probably should remember, but honestly, until you just said that, I totally forgot that's what our first episode was, right? But it's funny how it all actually ties together.
Yeah.
And it's not the sexiest part of building a portfolio, but it's definitely one of the most important. Like, without a doubt, is one of the most important, because if you don't do it, then it's going to really hold you back, right? So, like for me, the really big reason why you need to conduct the portfolio review is because, as we've spoken about before, there is a portfolio building process, right? Which is you start with your foundation, you move into your acceleration, then eventually you move on to your retirement, right? Yep. And it's very very simple when we do it like that, right? But it's obviously a lot more complicated when we kind of, like break each of those phases down. But if you're not reviewing, you're not going to understand properly which part of that process you're at. But then you're also you're not going to understand what stage of each part of the process you're at. And what I mean by that is the first stage is the foundation.
Yeah.
But where in the foundation are you sitting?
Yeah.
If you've been smart enough to have a portfolio plan, or maybe even have us build your portfolio plan, you might be looking at that and going, oh, well, I know that I'm meant to have 4 acquisitions in my foundational phase, and I'm only I've done number 2, but I've still got 3 and 4 to go.
Yeah.
Or maybe a better example would be, I've done 3, but I've still got 4 that's meant to happen.
Yeah.
But what happens if you've outperformed what you were meant
Exactly. I
to
was
with
about to
those
say
three?
that, yeah.
Right? So now, if you're actually doing a review, you might realize you're now ready to move on to your acceleration, the acceleration stage. But if you didn't review, you may end up buying an additional foundational property that you didn't need. And that's going to take up borrowing. It's going to take up potentially performance. It's going to potentially then take you longer because you're moving into the next phase. So it's so important from that portfolio building process point of view to review it because it's not always for the negative, right? The other side of the equation is you might be behind track, you know? But I don't want people to always think you need to review because you're trying to see a negative. It can also be because you might have an awesome positive.
That's true. That is true. So in this episode, we're going to break down actually how you go about conducting an in-depth portfolio review and the process that we follow here at Atlas to do that for our clients. But I guess before we kind of jump into the how, like you've covered off one of the reasons why, and we could probably come up with a couple of other reasons why you should, but we also want to understand when you should be conducting these kind of reviews as well. So,
I think I'll give one more why, and then I'll do your when. Because I know you're a big when guy. You're like, when are you going to do this? When's it happening? You like to push, and I love that. It's one of the things I love about you. He's going red. Everyone listening in. But I think the last why that I want to talk about, and it probably links into what I was just saying right at the end there, is that something that we see more than people might believe. Something that we see more than some people might believe we actually do is actually on that positive side. And it's when people think they need to continue growing their portfolio, but it actually could be that they just need to change their portfolio, right? So I've got a really good client example, right? We've got this client, great bloke, absolute great bloke. Worked with him for a little bit now, and he's a very seasoned investor, right? But it's also interesting because he's quite experienced, but he's also that classic example, and I've talked about it. I can't remember if I talked about it on this podcast. I definitely did it on one of my other ones where I talked about different biases and things like that. But there's this thing called the Dunning-Kruger effect. I've talked to you about that, haven't I? I'll chewed your ear off about it, right? But for everyone who doesn't know, basically the Dunning-Kruger effect is that that the less you know about a topic, the more you can sometimes think that you know, right? And that's why you'll see scenarios where some of the smartest people in the world will be the first to say, I do know a little bit about this, but there's still so much I don't know.
Yeah.
But then it's also why when you see somebody in the early stages of learning a skill or something, they have that really initial early stage of confidence where they first pick it up, but then a mistake happens and they realize how much they didn't know.
That's a reality.
And they come smashing back down, right?
Yeah.
Where I'm leading with this is this client of ours, he has, I think, 12 properties, 12 or 13 properties. Really, really smart guy, but also the first one to admit he can be quite inexperienced when it comes to property investing. He's just used a lot of really good help, of which we are we're the biggest one for him. But when we had a discussion with him actually earlier this year about his portfolio, naturally his first thought was, guys, like what's next for me? I need to buy my next property. I'm really keen to go. But we did the portfolio review and we unpacked as part of that because he already had a portfolio plan with us.
Yeah.
Just realigned his goals, made sure they make sense, made sure they were still accurate. And we actually worked out that with his portfolio, he actually didn't need to buy any more properties, especially in the way that he was thinking. We actually needed to downsize a little bit of his portfolio, pay out a little bit of debt against it, reposition for, I think it was maybe one or two more purchases, but we were actually shrinking the portfolio.
Yeah.
But the only reason we knew to do that was because we did the review for him. And he knew that he didn't know how to do it properly himself. So after that, we went from this scenario of him thinking he needed to grow his portfolio when it was actually the opposite. He actually needed to shrink it.
Yeah.
And he now has a better result with less properties than he did with more.
I mean, portfolio review on 12 properties, it would have been a pretty in-depth document, I can imagine.
I think because we do it in-house, right? We have a portfolio review service in-house, which I'll talk about a bit later. That 12 property portfolio, I think it was a 60-page document.
Yeah, wow.
Roughly. 60 to 70-page document that we created for him to do it, right? So pretty the staff member that we know that worked on that, hair was getting pulled out.
Yeah. But if you had kind of evaluated his portfolio without actually showing him the evidence of doing a portfolio review, like if you told him that he had to sell and consolidate some debt, he probably would have been like, well, I don't actually think that's the right play. But because you broke it down in such detail,
it's pretty crazy, isn't it? It's pretty crazy.
You can't really debate the numbers, right? So
no, you cannot, Lukey. But mate, I want to answer your second question, which was about when to do it, right? So at the end of the day, the big message I want to convey around portfolio reviews and adjustments is do it when you feel is right. However, I always think, like personally and professionally, there are a few big key triggers that I basically think of when I'm thinking about it, right? So for me, the first one would be is that I'll be doing a portfolio review probably at least every 12 months, right?
Every 12 months?
Every 12 months, right?
What if you're someone that's a little bit more aggressive, like the guy that I was speaking about earlier?
Yeah, true. So I would say like you can do it earlier, right? I definitely wouldn't do it any earlier than 6 months. But the problem with doing it at 6 is that you might not actually see that many changes, right? Like over the last few years, especially as more, pretty much everybody knows, markets have moved very rapidly. But it's also a circumstance of like things can take a bit of time to catch up. Valuations may take a bit of time to catch up. There might not be, that many rate movements that go on. Like you think if we were having this conversation like 2 years ago, you wouldn't be reviewing your portfolio that much from the financial point of view with your loans because if anything, your rates would have been going up, right? So, for me, you can do it at 6, but I like 12. And for some people, I think might even think, oh, that's like how much can really change in 12 months? But the point of 12 months at a minimum is at 12 months, it's enough time that something should have happened. And it also means your finger is on the pulse every year, typically, including ours. And the cost of a portfolio review activity, like what we do for clients, tax deductible. So you can usually just bang it into your tax and you're going to get a chunk of money back from it. But it sets you up every year to have a really good feeling about where your portfolio is at. And the problem that happens is if you don't do it 1 year, suddenly 1 year becomes 2 becomes 3 or 4, and suddenly you're years down the road and you're thinking, oh man, I've put my head in the sand. I was going to outsource this anyway, let alone doing it myself. And now I have really no idea where my portfolio sits.
I would say probably one of the exceptions to that in terms of like, I know you said like typically minimum 12 months. But if you're somebody that's had a pretty big or a significant like personal change in your life, like income or a lump sum payment fall into your lap, like if your income has increased significantly and you have a property in your portfolio, doing a review might highlight that, okay, your serviceability is now increased because your income's gone up, but you've now got a property where you might have identified through the review that you could do some kind of cosmetic uplift to that property to be able to build the equity base. Because you now got the serviceability, you've built the equity base up now, you can extract it and then go into your next opportunity a little bit sooner.
Yeah, I think it all depends, right? Like I definitely agree with you. Like a change of personal circumstance can be a really, really big identifier for a review, And like you said, the most common ones are going to be a big change in your income, maybe it's an inheritance or some sort of lump sum. The other side is it can also be like they're kind of, well, I guess not the inheritance for obvious reasons, but getting the money at least. Like they're kind of positive circumstances, right? Like they're like a positive impact probably is a better way to describe it rather than positive circumstances. Positive impact to your financial situation. But the other side is there can also be negative for your financials, right? And like, again, it's about the financials, not about the life, right? If you have a child, right? Or you're about to, or you're thinking of having children, that is going to negatively impact your financial circumstance. So like, for example, I would say we actually have a lot of clients like this at the moment. They've come and I always like it when they actually communicate with us, right? But they've said like, hey, we're thinking about starting a family, obviously everybody knows it doesn't happen overnight. It can be a bit of a journey, especially for some people. But by starting now, we were able to talk to them and say like, look, if you go down this road now, this is your impact, right? And this is what we're planning to do over the next 6 months or 12 months or whatever. So you just need to make a decision because like, I can think of one client. I think we're looking at doing 2 acquisitions for them over the next 12 months. We did one, I think 6 months ago. We got 2 that are meant to come up over the next 12 months. They said that to us. And we obviously spoke back to them about like the repercussions. And they actually said, well, you know what? We're still really young. We'd probably rather actually secure these extra properties and wait 12 more months to look at starting a family.
Yeah.
Right. So you also have that side, and obviously you then got
course,
like loss of job or
Yeah.
changes of income down, or
So would you suggest
Yeah.
like if something significant like that happened in your personal life that let's just say you hypothetically built out your portfolio plan 1 year and then 12 months down the road, or say not even 12 months, say 3 months down the road, you lose your job. Like, should you be reviewing your portfolio plan at that point, or do you think?
No, I think you still need to add an element of like a relativity to a relativism, right? Like I would say most people that lose their job, they're intending to go find another job, right? So like, you know, like you know what I mean? Like it's sort of unless you're planning, unless you're I don't know, like I'm trying to think of your very like classic examples, like maybe you're some hotshot lawyer, but you're stressed and you're burnt out. You're like, you know what? I now would rather go and like work at Bunnings because I just need a bit of a career break. And I'd rather be able to rock up to my work, do my job, and then leave and not have to take it home. Maybe like that sort of circumstance, right? But like if you're a lawyer who loses your job, but you love being a lawyer and you're going to go out and be another lawyer, probably not going to be
Exactly
that.
right.
You know, it's not going to be that big of a deal, right? So, but yeah, so I think change of personal circumstance. The only other two, the other two biggest ones I would think of would be around every acquisition. So,
Of course, that's the most
of course,
logical one.
Yeah, I mean, I'll caveat that with saying that like if you're buying like a couple in quick succession, you probably don't need to do that because not much is really going to have changed. But you know, most people they're going to be trying to buy probably like every 1 to 3 years.
Yeah.
So doing it around an acquisition is a really good time, especially if you might have missed your minimum 12 months. It's now 2 years later. You're like, okay, well, I'm planning to buy again. I want to do it.
Yeah.
And then I'd say the last example would be changes in the property market. So I would say the difficulty with this one is that it requires you to be aware of the changes and especially the nuanced changes in the market that you're in, right? So what I mean by that is that like you could take that up to a higher level and you could be like, oh, it changes in the Australian property market. And like you see it on the news all the time, all this stuff, but we all know that there's no, like that doesn't impact, the Australian property market doesn't necessarily impact an individual market, right? So you could be aware of that. And if you see that the Australian property market, I'm saying that in inverted commas, is performing really well and you know that you bought your property at a time when it wasn't doing so well, well, yeah, sure, maybe that's a trigger. But what I really mean is if you're somebody that's on top of it and you know that region or that area that you bought within is really having a cracker time, that could be a good chance. The problem is that most people don't do that because most people aren't doing this professionally, right? Like most people are in it, they get a bit of help from us or from somebody else, and then the idea is set and forget, and there can be a lot of forget, you know?
So then I guess for those that may not necessarily want to use the services of somebody else and they want to try to figure it out on their own, what would you recommend that they do to try to get a bit of an understanding on what's going on in that market, I guess? Or
I think it's hard, right? Like at the end of the day, we're all good at our own unique different things. The easiest thing to do is to read, right? Like read and stay up to date. But like I think of a lot of the clients that we work with, and I think there's honestly a lot of them that like property isn't really a passion for them. Like I don't think I could actually hand on heart be like, I can tell that you're really passionate about this. Like they like the result.
Yeah.
They think it's interesting. They're happy to talk at the barbecue about it. But it's not the same way that you and I talk about. Like I think you and I have a passion. Like we love it. You know, I think everyone who we work with love it, right?
Yeah.
I don't think a lot of our clients are like that. So I think it can be hard to kind of stay up to date. So in that case, you want a good team around you. You know, you want a good buyer's agent. You want a good accountant. You want a good mortgage broker.
Yeah.
But I will caveat that again with saying like, you got to remember though, you might have a cracking accountant, for example. Doesn't mean they always know what's going on in the property markets. Just because they seem like they think that they do as well, that's not their expertise. Their expertise is your tax and your structuring and things like that. And now they very well might be well on top of it and know. But I also know that, you know, we have this conversation with people's accountants a lot where they kind of get a little bit outside their box. They reckon they're an expert. They don't really know the deep dive knowledge. They just sort of think they do.
Yeah, we've seen that quite a few times, actually.
Yeah.
Well, I guess, mate, jumping in now. So we want to talk about how to actually conduct a portfolio review properly, right? So I guess before we kind of dive into the nitty gritty of it, though, I think what would also be really important for our listeners to understand is what can be the long-term impacts when reviewing, especially when action isn't taken. So you've done the review, but you're just like, okay, this looks great on a document. But if they actually don't take action with that newfound information, what are some of the repercussions of that?
I think that's a really good question. It's probably the best one you've asked today, mate. It's the best. It's the best one you've asked today.
I don't know if that's a compliment. Or
I don't think I meant it as one when I said it, but all jokes aside, it is a really good question because I think that for a lot of people, A, they don't review, which is already an issue in and of itself, or B, a lot of people are afraid to pull back the curtain and they want to put their head in the sand.
Yeah.
So that even when they get as far as doing it, they then don't want to take action because it's hard, it's time consuming, or maybe it basically admits that they made a mistake, right? So for me, I'd say that there are probably three big long-term impacts that occur, especially if you don't take action out of it, right? So for me, it's not the biggest in the sense of the long term, but it's the biggest, I think, in terms of the here and now, and it flows onto the long term, is opportunity cost. So
yes.
Property is definitely, I think, a game of opportunity cost, right? Like there are thousands of properties for sale at any one point in time. There are hundreds and hundreds of markets that you could go to, if not potentially thousands.
Yeah.
So it's always a game of like, what's the opportunity cost, right? And I think when it comes to reviewing and people's portfolios, what I see time and time again, I know that you do as well, is that people, because they often have attachment, maybe it was their first property, maybe it's just the fact it's a really big expense, maybe it's the fact that like, at the end of the day, most people don't own many properties over their lifetime. They can become really attached to a property, even if it's an anchor on their portfolio.
100%, man.
Yeah?
Especially when they're the ones that have actually been the person responsible for choosing that property in that market as well. They get emotionally attached. And it could be, a market that looks really good at face value, but typically when I speak to clients, like if they've held a property for 5 years and it hasn't really performed, you can tell that they're kind of like, if I hold it for another 5-10 years, it's going to come good. It's going to come good, right? They're trying to convince themselves that they still made a right decision for the longer term.
It's hard, right? And it's hard. And I guess that's what we call a sunk cost fallacy, right? Which is where basically you've got the actual dollars that have been sunk into it, but you've also got your time and your emotion.
Yeah.
And it's the idea that basically you need to keep sticking it out because you've already contributed so much to it in whatever form that contribution is, that like it has to come good or that you just have to see it out or something like that. But, and this is why the review is so important, right? And this is why, like I said before, 12 properties, 60 to 70 page review for our client that we did that for. You need to actually deeply review because just because a property hasn't performed for the last 5 years doesn't mean it's going to, but it also doesn't mean it won't.
Yeah.
But you need to actually conduct the proper review to be able to ascertain whether it's there. And if it's not, maybe selling is the right option. Yeah. Maybe that means it's been 5 or 10 years of owning it, and maybe after everything, you'll be break even, and that's not bad. Maybe you'll actually be behind and you'll lose money. But the question is about opportunity cost.
Yeah.
And it's about if I can get that borrowing back, if I can get some of those funds back, whatever it might be, if I can then go and buy something that's actually going to perform, how is that going to impact my long term compared to my sunk cost fallacy?
But I think some of the biggest fears that people have is they've paid for that property, they've held it for 5 years, hasn't grown at a beneficial rate. They're like, well, when we sell, we've got the exit fees, we've got capital gains tax. And then when we buy again, we could be buying another dud that doesn't grow for 5 years.
Yeah.
So I think these are the kind of scenarios that play on people's mind and that really holds them back from actually doing a lot better than where they're at.
I couldn't agree more. But I think that's what we're really talking about, right? And I think that's why, truthfully, I think that portfolio reviews need to be done by not you, because
bias.
Exactly right. It's going to be really hard for you to actually, from an unbiased point of view, review that, right? Because you're going to be taking in a whole bunch of confirmation bias because you want to confirm that what you've done is correct.
Yeah.
Right?
Especially if you have to share that information with your partner and things
exactly
like that.
Right. Exactly right. So I said that there were three things, right? First one's opportunity costs, right? The next one is, and it kind of links into opportunity cost, is a failure to scale. And what I mean by that is if you don't review those, the the impacts that are going on within the portfolio can really operate as a handbrake for you being able to scale, move through your foundation, move into your acceleration, move towards retirement, because you don't have an asset that is working efficiently or effectively, right? Or assets that aren't doing that. So if you can't scale, it's going to be really hard for you to reach retirement, right? Like at the end of the day, people aren't going to retire off 2 properties, and we've talked about that before. If you're starting late and that's all you can do, or if that's just all you can do over your lifetime, that's going to be better than nothing, of course.
Yeah.
But it's not going to give you complete like financial freedom.
Yeah.
You know?
Yeah.
So by not reviewing, one of the biggest long-term impacts is that failure to scale, which then moves into the third thing,
Which is
a failure to achieve your goals.
exactly right.
Right? And because you can't scale, you're not going to get to your goals. And if you fail to achieve your goals, I'm not going to say what has been the point, because even if you don't achieve them but you get a good result, that's still obviously better than nothing.
Yeah.
But if you've had a long time to do it and all you've done is waste your time, I almost think that's just really sad.
Yeah.
Like, it's really sad that through your own almost ignorance and your unwillingness to review your own performance, you're now not going to achieve your goals. The only person that's really going to hurt is you,
100%.
or your spouse.
Yeah, and we got a really got a good sport analogy, and I know you typically leave the sport analogies to me, but I'll let you have this one today.
Let me take
I think you've
this
got that. Was it the NFL one?
Yeah, I got a good NFL one here, right? So I think this whole idea of reviewing really can be kind of equated back into sports, right? It doesn't matter what sport you play or what sport we're talking about professionally. They all go back and they all go and watch, game film, basically, tapes, right? And the whole point is to review your performance. It doesn't matter whether you're a cricket player reviewing your form in a shot.
Yeah.
It doesn't matter whether you're a soccer player trying to work out the tactics of the other team, or in this case, the NFL. And I think the NFL is a good one because I don't think there's another sport that I know of where they watch game film as much as they do in the NFL.
Yeah.
Like, they'll have whole days in a week between games devoted to sitting there and reviewing the tape, right?
Yeah.
And I think if we take this back to the portfolio review, it's if you can't do that, how are you going to know when you're doing things well and you're doing things wrong?
Exactly right.
Right? Like,
how can you identify the weaknesses if you're
For
not honest
sure.
with yourself and actually looking and deep diving into it?
100%. Right? You go look at, like, if it's good enough for the big blokes in the NFL who earn, some of them are earning 50, 60 million US dollars per year, not even including their endorsements, right? In 1 year, if it's good enough for them to do it about the thing that is going to give them financial security, which is their playing career, if they're smart with their money.
Yeah.
Why shouldn't you do it when the reality is your job is probably not going to set you free financially, but your property portfolio might?
Yeah.
That's the way I think about it.
Yeah.
Right?
I think it's a good way to think about it. So I guess if we start to look at the portfolio review process, so there's a couple of different stages to it, right?
Yeah.
So I think there's around 5 different stages that we've got. So we're going to be breaking down a financial review, a performance and improvements review, and also an opportunity cost review and an overall portfolio review as well, right? So I guess attacking it from the top down, I think looking at it from a financial review perspective, what comes to mind to me, and I know that we've included this into our service offering, is first things that we typically look at from a financial review perspective are your interest rates.
Yeah.
Right? We also want to understand what your property management rates look like on the property, and then also whether you've got a depreciation schedule on the property as well.
Yep.
Right? Is there anything else that you can add?
I think,
to
look, off the
financial
top of my
review?
head, it's those types of things, right? You're talking about the real financial, like the things that financially impact you around it, right? It could even be things like your land valuations. Do you think it's accurate? Do you need to challenge that with the state, the valuer general for your state, things like that? But it's all of those kinds of financial metrics, not about the property, but about sort of the other side of the financial metrics. And that can be some of your quickest wins, right? Like understanding even just your interest rates. You could, like, I'm not kidding, like, we've done, I don't even know how many of these portfolio reviews for clients. And, for an average client, right, it might cost them $500 with us, right? And then they get more back on tax.
You know what? I actually remember that portfolio review that we did for that 12 property
Yeah.
client. I think at least 4 to 5 of those properties, he could have got sharper rates for those properties.
Well, you know what?
Yeah.
That's absolutely right. I mean, that's obviously an extreme example, but I think that he did end up going to do that, right? And I think for him, I think he ended up dropping about 0.5% across each one. So he was saving thousands and thousands of dollars a year just on that. But even at a simpler level, that's kind of what I was going to say, just more generally, right? Like, it might cost you $500 if you've got a few properties. If you've got 2 or 3 properties and you come to us, it might only cost you $500. Then you also get some back on tax, and we might be able to identify something as simple as interest rates. That might save you $1,500, $2,000 across all your properties. Like, imagine spending less than $500 to get $2,000 back.
100%.
Like, pretty
No
damn
brainer.
good, right?
No-brainer.
Yeah, but it goes to other things as well. Like you mentioned property management rates, right? You don't necessarily want the cheapest rate, right? But you want to have the right person. But you also want to know if you are maybe paying well outside market norms. Right? And I guess it's hard to know that if you're not an expert to review. But if you do know that's really helpful, right? Even things down like depreciation schedules, which you said as well. Man, that can be some of the easiest money in the world to claim back, and yet people don't do it.
Yeah, 100%. 100%. So that's the financial side. So moving on, we've now got the performance side of things, and this is where we start looking at, the growth of the property, what kind of rent is being achieved with the property, and whether or not there's an outperformance or an underperformance. Right.
So this is where it starts to get really interesting, and this is definitely at a property level, right? So naturally, like, this is what most people think about when they think about a portfolio review, right? Like, has my property grown enough? Has it not? Are the rents good? Is it not? Like, where does it sit? Where does it not? Like, that's what most people think of, and this is where it kind of gets bracketed in, right? The performance review. So you need to also try and set benchmarks, So, like, you want to go and look at the growth of your property, but you then want to go and compare it to, say, like, the area that it's in. Like, how's it performed?
The suburb average, right?
Or probably even more broadly,
average.
the region, like, how's it compared to that? How does it then compare maybe to the broader state, And it doesn't mean that, like, you're going to have the same numbers, but if it's all moving in a relatively proportionate fashion, that's pretty good. That's really helpful to understand. Or if you're really far behind your region / area or your state, then you got to really understand why, So being able to actually analyze that and check. Same thing then for the rents, making those comparisons, making sure that you understand where it is relative to its peers, because that's also opportunity cost.
Absolutely.
Right? So ultimately, what it all comes together is you want to understand if you're outperforming, underperforming, or you're on the benchmark. And like, I want to make it really clear to everyone. Property tends to experience a phenomena that we call mean reversion. And what that means is that over time, and it doesn't mean 6 months, but it doesn't mean it has to be 20 years either. It could even be 2 or 3 years. It really depends on where you've bought and how you've bought and all the rest. Your property performance will revert to the mean. So what we mean by that is if the long running growth in an area is X%, let's say it was 8% or something, but then you have got 20% in your first year and 22% in your second year, it ain't going to go that way the whole time, right? It will eventually come back and it will revert to the mean, right? But the point is that by understanding your outperformance or your underperformance, you can start to get a really good measure for whether or not you're in a good property for that area as well. Because like I've seen countless examples of people that we've done this for, where they'll have, say, 2 or 3 properties, 1 or 2 of them. Like, to me, if it's plus or minus about 10% of the benchmarks that we utilize internally, that's fine, right? Because there's error in valuation, there's error in market data, there's lag, there's all sorts of things, right? But if you're about plus or minus 10%, I go, yeah, that's pretty good. I've seen somewhere it's behind by like 40, 50%. And in examples like that, when we've then talked to the client, the client thought they bought a really good property for the area.
Yeah.
But when we've deep dived, we've realized the property doesn't match the area, and that's why it's not performing.
Yeah.
And it could be as simple as something like you've bought a 5-bedroom house thinking, oh my God, more bedrooms, more space, everyone's going to want it. But the area actually has a demand primarily for 3-bedroom houses or maybe a slightly less but still pretty prevalent 4-bedroom demand.
Yeah.
5, it's hard to rent, and then
yeah.
because there's less people that want it, whenever somebody moves out, you got to leave the rent the same to get somebody back in. So your rent doesn't go up and then your growth doesn't, and so on and so forth, right?
I guess I know this is going a little bit off topic, but with something that you mentioned before, with if someone's bought a property and they've experienced like, say, 10% growth in the first year, 15 the second year, another 15 in the third year, right? With what you were saying in terms of, it reverting back to the mean.
Yeah.
For a lot of people listening, they're like, well, if I've achieved that kind of growth over that 3-year, 4-year period, does it make sense for me to actually hold the property any longer? Or should I sell and then repurpose those funds in a different growth market? Right? Does it make sense? Does it financially stack up with all the exit costs and entry costs to do that? Right? What are your thoughts on that?
I think you kind of hit the nail on the head. You have to just really see if it stacks up, because the power of property is that, like, it comes from the long term, right? So, like, the point of trying to supercharge your growth at the start is typically one of the hardest things for people to get is the funds to buy your next property, right? Like, of course, borrowing comes into it at a certain point, but like if you got to drop $100,000 per property, like how long is it going to take most people to save $100,000, right? So the point of like trying to supercharge the front end, and like that's why, for us, like with our clients, we tend to average, around 20% in their first year, right? If not often more than that, right? And the point is because that then sets them up to move into their next property.
Yeah.
When you get to the not back end, but like when you get to the point where you start to experience that mean reversion, I often think it doesn't necessarily mean to sell it, because the power of property is in compounding and the leverage that goes along with it. But if you've had that supercharged growth, that can mean that the property's already done what a big element of its primary purpose was, which was to help you to get into your second or to get into your third or whatever it is.
Yeah.
And after that, as long as you don't expect the market to be tanking or anything like that, staying is often the best result. That's what I'd say about it.
Yeah. All righty. Well, then moving on to the improvements review side of things now. So this is where we're actually having a look at the property itself. What can be done to the property? Could we do, a cosmetic uplift to the property? Could we subdivide it? Could we put a granny flat out the back? Those kind of aspects, and how it ties into the overall plan and the overall expansion of the portfolio, right? So, yeah, what are your thoughts on the improvement side?
I think you hit the nail on the head, right? That's where it's not about necessarily doing it today, but it's about always remaining aware and cognizant of what you can do, right? And I think like the easiest one, for example, would be like the cosmetic renos, right? Like you're looking at it and you're going, you know what? Like the kitchen in my place could do with a bit of a facelift, right? It's absolutely fine as it is today. It still rents, no problems. Tenants are fine. There's no dramas. But I'm already mentally noting the fact that like that's the next step for us, right? Like on that property, not the next step. That's like a thing that we can do, right? But it really is going to depend on where you're at in your portfolio, because if you have all these different improvements that you could do, that costs money. And are you at a stage where that money is better spent where the money is a portion of a deposit for a next property?
Yeah, exactly.
Right? Like trying to leverage more. Or are you at a point where it's like, oh man, like we can't borrow really for another 4 or 5 years.
What can I do to that property?
Exactly right. Yeah.
Increase its equity, maybe increase the rent once the lease expires. Those
for
kind
sure.
of things. Yeah.
Especially if you've got excess money sitting around. You're like, you know what? Throw this into it. How good, or some excess equity that you think that you could, utilize well. But, improvements then also goes on to maybe your development side. So it could be, can you subdivide it? Can you split it? Could you develop it further? I think the biggest thing is you're always keeping your eye out and you're being aware of it. So that way you're never shocked. You're never like, oh, I didn't realize I could do that. You're always aware of all the secret hidden gems, those little treasure chests that sit in your portfolio that on a rainy day you could utilize if you really wanted.
Yeah. I think that's fair. And I think the next one that we're talking about is opportunity cost review. And I think it kind of ties in nicely with what you were saying before in the sense that some people do unnecessary renos, right? They pour hundreds of thousands of dollars into improving an asset where it's not really going to be moving the needle that much. Like just because you put 200K of renovations into a property doesn't necessarily translate to 200K in increased value of the property. And it also doesn't necessarily translate into greater rent, especially if it's your owner occupier, right? You're getting no extra rent from it.
Yeah.
So the opportunity cost side of things, if that 200K was being put into like the deposit or a deposit for say multiple properties, then what's the compounding effect of being able to get say 600K properties as opposed to doing a 200K reno on an owner occupier?
Yeah, I completely agree. And I think that the opportunity cost is really important because people often just want to have movement for the sake of it. And they want to feel like they're doing something when sometimes doing nothing is actually best. And that's still an active decision. Like, like if you're going to sell a property, are you even going to be able to borrow enough money to buy another property?
Yeah.
Or are you better to keep the one you have? It might not be performing as well as you'd like it to, but it's still not doing too bad. And you're doing a lot better than having that money parked in the bank.
Yeah.
But like why sell it if you didn't need to? You're not going to get a better return and you can't buy another property, Yeah. But a lot of time people won't think about that. And that's why the opportunity cost review, it's so important. It doesn't mean you need to have all the answers, but if you need to be thinking 3 or 4 steps ahead, or you're going to make a very rash decision that's going to have quite significant long-term impacts, and you're not going to be able to unwind that.
Yeah, I think you're spot on. And then the last one we've got here is overall portfolio review.
Yeah. So this is where we now really try to tie together everything that's going on. Now, if you've only got one property, well then, hey, your portfolio review is pretty much the same as your property review, right? But obviously, as you get bigger, it becomes more and more important because you also need to understand how things are going at a portfolio level, right? So to me, there's usually two of the biggest things I think about with this are first, where are you at in the portfolio building process? So by really being able to break down each of the properties, understand where they're at, their pros, their cons, their improvements, their opportunity costs, all the rest, you can then get an aggregated idea, so a portfolio level idea of where you're at in the portfolio building process, sorry. By understanding that, kind of like the example I gave before of the guy that we work with really closely that's got 12 properties, you can then understand like what your next steps are. You can understand if you need to adjust. You can understand what's going on, right? The second part is that also your diversification. So that could be across location, that could be across asset types, that could be across the lenders for your banks, that could, the lenders for your loans. It can be across a whole bunch of areas. But by actually putting it all together, say in like one consolidated document, for example, like what we do, it allows you to bring all the pieces together to understand where your risks exist. And ultimately, that is one of the biggest things about the portfolio review is understanding where your risks lie. Yeah. Right? So for me, that overall portfolio review is typically dealing with those two things. Where you're at in the portfolio building process, what's next, what might need to change if you're on track, behind track, off track, whatever it is. And then how your overall risk and diversification sits. Yeah.
So once we've kind of conducted the in-depth analysis of the portfolio review, there's a couple of different courses of actions that we can take, right? So the first one is there's no change to the portfolio plan at all. So we're happy with how things are ticking along and it's going in the right direction, which we're content with. The second one is we adjust the portfolio plan, right? So as you mentioned earlier, you might be at 3 properties in your foundational phase of your journey, and those properties have outperformed, right? And you don't need to acquire another one, and you can jump into the acceleration phase, right? The third one is actually making improvements to your property or the financials behind it. So that's whether or not you do, a cosmetic reno to the property. It's whether you, decrease your interest rates or get a sharper rate with property managers or get a depreciation schedule put on the property. And then one of the other ones is selling the property, right? You've got an absolute dud, a lemon, sucking up your capital, sucking up your serviceability, and you want to get out of that asset and repurpose funds elsewhere. And then the last one is paying down debt across your existing portfolio. Any of those that you want to expand on, matey?
Oh, look, if I go through no change to the portfolio plan, I think that's pretty self-explanatory, right? Like that's just you're on course and stay the course, right? Adjusting the portfolio plan, I like how you link that back to what we were talking about before. That is really like, that can be positive, it can be negative. It also implies the fact that you've got your portfolio plan. So if you don't, that's already a problem itself. But you know, making adjustments, right, to account for changing goals, changing circumstances, better performance, worse performance, whatever it might be. Yep, I like what you said around the improvement side. Like, that's really about making sort of smaller tactical level changes, i.e. on a property rather than at the whole portfolio level. And like you said, you know, that could be something like improvements to the property, or it could be like changing numbers, like rates, whatever, on your finances. The two I really probably want to touch on properly is the sell and pay down debt one. So for me, the sell, this is a really big decision, right? Because often Murphy's Law will say the minute you decide to sell, suddenly it performs, right? But I guess that's the real value and power of a proper review, is it can at least bring out all the information to help you make the most informed decision that you can. And like, I think of it, we've got a client, we do bring him up a little bit on this show, but he's a perfect example of this. He had a property before he came to us. He's now bought 3 properties with us. And then we did a review for him, and we told him that the property here he already owned, it was an apartment in a pretty mass built out area. It was just a bit of a dud. And actually, we didn't explicitly say, go sell this property, but we gave him all the facts and allowed him to draw his own conclusions, and obviously talk to him about that. And he made the big active decision to sell, and that was what allowed him to get into his second and his third property. And now he's got a 3-property portfolio instead of what would have been handbraked at 2, and they're performing 10x better than what it would have been, right? But the sell side, it can be really emotional, but you have to be as unemotional as you can about it. And if it's not right, get rid of it. You know? And then the paying down the debt side obviously links in the sell. You're not going to pay down debt without selling. But when you sell, you kind of have 2 options, right? It could be because there's an anchor or something that's not doing very well, and you want to repurpose those funds into another property purchase, like what the client example I said was. Or it could be to pay down debt, and that really could be like an adjustment to your portfolio plan. So some of these things actually work together. It could be that you're further ahead than you thought. It could be that you've had a life change, whatever it might be. But you might be making the active decision, you know, it's not the right time to keep growing, or we're now done growing, and you actually want to reduce debt. And that could be for cash flow reasons. It could be risk reasons. You know, there's different things that might be factoring into that decision. But I think that the most important part is that something like paying down debt comes around a lot faster than what people think it might. And for a lot of people, that can be a real safety net.
Okay. Alrighty. And then I guess to kind of close off the episode, mate, there's a couple of things that we want to speak about. Obviously, for those who've listened all the way through, you would have heard Lockie at the start mention our end of financial year offer that we've already had a lot of people kind of take us up on. I think we've got a few spots available with that one as well. So we're going to speak about that. And then also, I think, Lockie, you're going to talk about the portfolio review service. To the listeners as well.
So guys, 2 massive calls to action for you, right? So if you're sitting there listening to this, wherever you are, on the train, in the car, on the toilet, wherever you are, right, having a listen, if you've got a portfolio, right, and you want to have us review it, actually going into the depth and detail that we've spoken about today, but having somebody professional do it for you, come have a chat to us, right? atlaspropertygroup.com.au/portfolio review, all right? We'll give you a call. We'll explain how we can help out. We'll see what your situation looks like, and we might be able to do that real deep dive for you. And like I said, it might not be as expensive as you think. You know, for your average person, it might only cost you $500 or $600, right? So pretty straightforward. And considering we're coming up on tax time, good chance to maybe throw a couple extra deductions into the mix, right? So that's the first one, portfolio review service. And then our end of financial year offer. It's been brought up a few times across the last few episodes. We are offering $1,500 off. There are some T's and C's which will tell you when you let us know that you'd like to claim the offer on your call with us. However, if you'd like to go and work with us, you know, and we were saying before about our results, and you'd like to save money at the same time, come and have a chat with us. I didn't actually look at the number before we came in, but I think we're probably around like 13 or 14 spots available.
I think it's around that amount.
Around that amount. So if you are thinking about doing it, at least get in touch, have the call with us so you can get your spot locked up, right? Even if you do have to think about it for a week or 2, but come and have a chat with us. So otherwise, Lukey, thanks for another great episode, mate.
I've enjoyed it, man.
A lot of ground covered, and a really important topic to me. A really, really important topic to me.
Awesome, man. Well, thanks for listening, guys, and we'll see you on the next one.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.